Good morning, it's Keith Fitz-Gerald. Thank you very much for joining me here at Freedom Fest Facebook Live. I'm really excited to be able to bring this to you today, and thank you to every single one of you who sent in the questions that are on your mind. Chances are, if you're thinking about it, I should be thinking about it, and every member of the Total Wealth and Money Map Report family should be thinking about it. So let's get rolling. I've got a number of great questions right on the screen, and I'm just going to walk right through them one by one, and if there's follow-on, follow-up, I'll be back again. Let's get started. First up, how long do you think the stock market will continue to rally? That is a really important question at the moment for one reason, because rally is driven by liquidity. If there's a lot of money chasing a lot of stocks, then guess what? The natural path of least resistance is higher. How long that lasts, I don't know. That's an unknown. So the question becomes, how do you manage risk in the meantime? The worst thing you can do is try to second guess the markets. I think we're looking at another 5, maybe even 10% before we get signs of euphoria, before we see the bubble-like valuations that we saw prior to prior corrections. Second question, should I stay in the market now? I get that question a lot. Obviously, I don't know your personal background, I don't know your personal investment objectives, so I can't advise you personally. But here's the thing, if you're not in the markets, then you're trying to second guess the markets. By its very definition, that's a bad thing. Trying to time the markets never works out. But should I be in the markets is a more subtle question. I think if you're in the markets, you're tapping into the future, into growth. So the question becomes, should I be in to win? And the answer is emphatically, yes, you should. Third question. I also get this one a lot. I don't have a lot of money. What's the best way for me to invest, even if I only have a little? You are not out of luck. One of the great things about the stock market and about the recommendations that I make is that they're suitable for a wide range of people for 3 reasons. We're concentrating on unstoppable trend backed by trillions of dollars that must get spent no matter what. So the government can't screw them up, the Fed can't hijack them, Wall Street can't co-opt them. So how should you invest with a little? Obviously, safety is a big thing. You don't want to lose what you have in the markets. So you want to concentrate on the must-have companies, making the products we can't live without. You want to be lined up with those unstoppable trends, and you want to put risk management as an absolute priority. So we do that with trailing stops. There's all kinds of total wealth tactics that we write about, and that's a good place to go. Third question, is it worth it to invest in futures? That's a little more nuanced, and here's the answer. It can be worth it, but it can be worth it as part of a disciplined overall investment strategy. You don't want to invest in futures, for example, and be just about futures, because that's not diversifying, that's not even concentrating, that's taking an excessive risk. And that's not good with futures, that's not good with any stock for that matter, or bond or real estate. You never want all your eggs in one basket per se. So are futures valuable? Yes, they can be, but they can also be tremendously risky because there's margin and all kinds of leverage involved in them that are unique to your individual investment requirements. And I don't know what those are. So good question, that's the answer. Third one, stocks, annuity, or buy more property, which is the better investment? Again, this is a little nuanced depending on your personal investment situation, and I don't know what that is, so let's run down them each by each. Stocks, all about the future, all about growth potential. If you're tracking the right CEOs, the right products, making must-haves, I think that's a good bet because you're tapped into all of the growth and liquidity we just spoke about. Annuities, I'm not a big fan because those typically are overpriced, they've got lots of fees, they're very expensive. You can't be certain of the risk you're getting into because of who's on the other side of that contract. And here we go, property. You know, real estate's a tough one. I get a lot of flack for this, but real estate is nothing more than a proxy for keeping you out of the rental market. Over long periods of time, real estate has been shown not to do anything more than keep up with the pace of inflation. So if your time zone or your time frame is very long term and you want to live in the property you're going to occupy, then I say it makes a great investment because you're deriving the benefit from it. If you've got a unique short-term perspective and there's something that's going to change in the way of the land, for example, you buy a specific house in a development which has an exit path, or you're buying a building that's transitioning from one purpose to another. If you're into real estate that's backed by high-tech leases or medical properties, then I think real estate actually makes a very compelling investment, and I've recommended a few of those things along the years. I'll recommend them again, but only under very specific circumstances, because again, longer term, real estate is awash with inflation, and our goal is obviously to beat that and then some so that you have wealth at the end of the day. Next question. Amazon has been crushing retail, absolutely, but Walmart's been trying a number of tactics to stay ahead. Yes. Is there any chance Walmart will stand up to Amazon? Oh boy, oh boy, oh boy. I wish I didn't have to roll my eyes on this one, but to me, Walmart keeping up with Amazon provokes a big, oh. I think Walmart, contrary to what a lot of people think, is in very serious trouble. It is Amazon versus everybody else. And what I'm seeing out of, and I know that's not a popular thought, by the way, Amazon has got so much capital and so much strength and so much liquidity that it is Amazon versus every other retailer, including Walmart. The stuff that Walmart's doing right now is all about the Hail Mary pass. It's desperation. They're throwing stuff against the wall, hoping something's going to stick. Everything from asking their employees to take products home at night, to rearranging their shelves, to all of a sudden producing all of this online stuff. That's nothing more than a, hey, me too, we're doing this. Now it's going to attract a lot of sales and it's going to attract a lot of volume, but is it profitable? I'd rather place my bets with Amazon, for example. Good question, by the way. Next question. You've been very bullish on markets. Is there anything that could really threaten their upward trend? Yes, absolutely I have, and yes, absolutely there is. So the question becomes how you manage the risk. What are those threats? First threat is central banks doing something stupid around the world, and that causes liquidity to dry up. And if liquidity dries up, then there's really not a lot of money moving. And you can think about this like water. If the water in the spring dries, then the settlers move on to another homestead or farm. Same thing with the markets. If liquidity from the central banks dries, and again, whether it's right or wrong, that's a different question for another time, but if that liquidity dries up, then we've got a problem, because that means the money's going to stop moving. That's the one thing central bankers and politicians around the world do not want, is for that to dry up. So I'm betting they're going to throw everything but the kitchen sink, well, everything including the kitchen sink, the dog, the cat, the car, everything they can to keep that liquidity moving, because ultimately that benefits you and me by keeping the consumer segment of the economy alive. It represents 70-something% of the spending here in the United States, and that's important. Now, the other major impediment to markets, potentially, is a terrorist event. That's something that we don't want to think about, that I don't like thinking about. In fact, I find personally very, very disturbing, both as an investment professional, as a father, as a husband. I don't want to think about this stuff. But unfortunately, we've got to think about this stuff. To me, it's a large event, it's a dirty bomb, it's a biological pathogen that gets released into society somehow by somebody who wants to do the world harm. But locally, I'm not worried about very much, because we've got the unstoppable trends, the must-have companies, and we're managing risk very carefully. So that doesn't keep me up at night. In fact, quite the opposite. I sleep very well because I know those are the things we're concentrating on, and everybody else is taking the risks we don't want. Next one. Keith, do you think the U.S. economy stands to suffer from international trade agreements being made around us, such as between the EU and Japan? Okay, there's two ways to think about this. First of all, you want to separate the political from the economic, because the political is driven by a set of variables and calculus that don't necessarily concern us. And you want to concentrate on the CEOs who understand how to make a buck. The really important part of that is that the CEOs will not stop looking ahead. They will not stop looking to the future. So history shows very clearly, beyond any shadow of a doubt, that international trade will continue and we will benefit from it. Think about this for a second. 52 to 62%, last time I looked, of all of the revenue from the S&P 500 companies, many of which are domiciled in the United States, is actually being made overseas. So contrary to what a lot of people think, we're already participating in all of that international trade. We're not being left out by any stretch of the imagination as an investor. As a nation, that's a different topic because we've got to have the governments aligned. So separate the two, concentrate on the CEOs, ignore the politicians, and you're going to sort this out. The CEOs are the way to go. Alrighty, are you concerned about housing bubbles around the world right now, particularly in China and Vancouver, Canada? Could they burst and impact the US economy? Interesting question. As a matter of fact, I was just in Vancouver, and I'll be back in Vancouver next week. It is absolutely a property bubble, and I'm seeing hovels being driven largely by, ironically, Chinese money. So yes, I'm extremely concerned about localized property values. Not so much in China, because there it's a different set of variables. You've got a middle class that is larger than the entire population of our country. The values there will sort themselves out. There's enough land that they can continue to do what they want to do. All of the ghost properties and things you hear about, really not an issue. There's pockets of things that are localized and concentrated, but they don't have the potential to blow up the entire economy. I don't see another subprime mortgage crisis, for example, as a result of a housing bubble. Vancouver, Canada, again, same thing. I don't think it's going to affect the US. I don't even think it's going to affect Canada that much if it slows down. But it's all about the leverage. Most of the Chinese buyers that are driving the values are buying in cash. So there isn't a lot of leverage like there was coming into the 2007-2008 financial crisis. Housing to me is a concern, but not a major concern. Where are big tech stocks headed in your direction? And do you think the tech bull market will end in a big crash? I think, number one, sorry, we've got a lot of noise here in the assembly hall. You know, it's actually really good because you can hear the noise around us. This is an exceptionally well-attended conference. I've got some other videos that are really cool, including people like Steve Forbes and Jim Rogers that I sat down with yesterday. So come back in when we don't have so much noise. Check out some of these other links you're going to see along the way. I think you're going to find them as compelling as I did when I sat down and talked to them. So let's get back to our questions. Where are tech stocks headed in your opinion? I think they're headed higher, and that's a function of growth. But it's not all tech stocks. It's the big must-have tech stocks that are changing the world, because these guys can click a button or release a line of code and add $1 billion in revenue overnight. You can't compete with that if you're a small company or a has-been or something that's got an undiscovered. It's the big guys that are truly changing the way the world lives that you want to be a part of, and that's why we prioritize them at Money Morning and Total Wealth and Money Map Report. Do I think the tech bull market will end in a big crash? No, and I'll tell you why. They're not going to crash because tech crashes in and of itself. In other words, are we going to have another repeat of the dot-bomb crisis in 99, 2000, 2001? No, I don't believe we will. Could tech crash as a function of an overall market decline? Absolutely, but that'll be driven by different reasons. Tech now is driven by real earnings, real customers, real process. We understand what .com actually means. We understand better as a society and as a market how to extract value from that. In 1999, you saw stupid little things like a talking sock that was supposedly worth $1 billion. No revenue. That doesn't happen, doesn't exist anymore. Investors have a razor-thin baloney meter, and you know what? They're good at detecting whether or not something's a bubble. So even if you look at Amazon, you look at Netflix, you look at Facebook, you look at Alphabet, valuations are not all that out of line with the past, and they're certainly nowhere near the PE ratios we saw in 99, 2000. So yes and no. Could crash, but it'll be because of other things, but unlikely. Keith, what stocks are you looking at now, and are Fang stocks worth the hype? Okay, the Fang stocks, Facebook, Apple, Netflix, and Google, of course. We coined that term and during news appearances. Yes, they're still worth the hype. I think, unfortunately, Silicon Valley is Silicon. I have my emphasis on a different syllable today. Silicon Valley is inhabited by a bunch of young folks, many of whom are very driven, very gifted, and exceptionally intelligent, who unfortunately have almost a complete lack of understanding of the social consequences of their actions and their products. So you talk about the hype. Are they really worth the hype? I think the answer is yes, because you take Alphabet, for example. you've got 8, 10, 12 multi-billion-dollar businesses within that company that have yet to be unlocked. Everything from big intelligence to artificial intelligence, big data, medical identification, DNA sequencing, artificial vision. I mean, these guys have got now so much money that they're well capitalized and can do whatever they want, but more importantly, these same stocks, with the exception of Netflix, so Facebook, Amazon, and Google in particular, have got the largest single accumulation of data in recorded history, and that has yet to be properly valued. I think when you break these companies up or you put them together, any way you cut it, we've only begun to tap into a fraction of what they're actually worth. Now Netflix, on the other hand, guys, I'm cautious on now. That's a one-trick pony. They've got a business model, to me, that is not sustainable. They've been great to get where they're going because they broke the mold, it's new, it's content. Everybody remembers mailing those things in. Now you can download your videos. But unless they have a lot of money, they can't produce the content. Unless they have the content, they can't attract the viewers. And they're like a rat on a treadmill. So if you look at my appearances on both CNBC and Fox Business Network recently, I've been very negative on Netflix. If you got it, hold it. Don't sell it unless the market tells you to, using a trailing stop or some of the other tactics we've talked about. But think very carefully about this. Unless Netflix lines up with a much bigger player, they're gonna go into the hinterlands. They're gonna vanish into that great financial graveyard of the sky because they couldn't keep up. Amazon's getting into original content, Alphabet's getting into original content, Facebook's getting into original content. They're all encroaching on what was formerly just Netflix space. Now, the rest of the Fang stocks, absolutely, again, they can release a line of code, change something, billion customers, $1 billion overnight. We haven't even begun to see what these things are worth if you got the right perspective. All righty. Are there any retail, well, no, wait a minute, I skipped a stock. Amazon is so expensive. Should I wait for a pullback, and do I think there will ever be a pullback? Good question. I don't think Amazon, again, has even shown a fraction of what it's ultimately going to be worth. Will there be a pullback? Not unless there's a broader market pullback. I don't think that you're going to get the chance to dive in, but that doesn't change the fact that you want to put a low ball order out there, throw an order out there to buy some shares, or simply change your tactics. Just because a stock is expensive doesn't mean that you have to be limited by something. You can, for example, buy a share or two, $800 or $1,000. That's a good way to get started. You're still going to harness it. You can use options, which we've talked about. You can use leap options, which are farther dated, give you an even better tracking mechanism for that long-term value. Or simply you can buy Amazon as part of a fund. Now, all three of those ways will get you into an expensive stock inexpensively and still allow you to participate. The other thing you can do, which I'm a big fan of, particularly if you're starting out or you've got a small amount of money or you don't have enough Amazon shares, value cost average in, or dollar cost average in. Take a fixed amount of money every single month. So let's say I've got $1,000 and I want to put it into Amazon. Well, I can't just go out and buy 100 shares of Amazon. A couple $100,000. That doesn't make sense. But what does make sense is I say, I want to buy one share this month, one share next month, one share the month after that. What happens over time, because of all that liquidity we talked about, the value is going like this, and as Amazon grows, the value is going like this, the stock is going to go up and down. If you're consistently buying little by little by little by little, over time you build up a very effective position at a far lower cost because you're buying some low, some high, some low, some higher, some lower, higher, and you so on and so on. So over time, you're using the market's natural ebbs and flows to your advantage. And it's interesting because the big institutions that we talk about all the time, the big trading firms, they don't have the luxury of doing what we're talking about. They have to be all in or all out, or they have to make decisions that keep their money moving. It's one of the few areas as an individual investor where you hold the cards, because you don't have to do that. You can make a decision to change your tactics. You don't have an investment mandate. You can do something differently. So again, to recap, just because a stock like Amazon is expensive does not mean you have to sit it out. Options, you can buy a share at a time, you can value cost average in, you can buy it as part of a fund. There's a half a dozen different ways to get into those very same stocks? Excellent question. Are there any retail stocks I would recommend, if any? Well, unfortunately, no. Right now, there's not a single conventional retailer I can think of that I would recommend. Not one. You know, the exception is Foot Locker, which I recommended a while ago. If you've got that stock, watch it carefully, watch your risk management. They've integrated the online-offline experience. But would I wade into the conventional retail stocks right now? Not with a 10-foot pole and not with $1 million. It's Amazon versus everybody else. And unless you've got an Amazon strategy, every single one of those retailers out there, particularly the big ones, the big department stores, they are dead on their feet and possibly should be on death watch. It's going to take a while because nobody believes it, but if you doubt me, look at what happened to Sears over the last 10 years. They've gone like that, everybody else has gone like this. Amazon in particular. Look what happened in particular to Sears yesterday. I guess it was yesterday or 2 days ago. They announced that they were going to sell one brand, Kenmore, on Amazon, and the stock jumped a few percent. To me, that's the Amazon effect, and that highlights why you should be with Amazon, not Sears, even if you're a trader. All righty. Which is the better investment in your late 40s? Stocks, annuities. There's the Liberty Bell again, that's good. Which is the better investment in your late 40s? Stocks, annuities, or buying more property? Again, that's an individual decision. That depends on how you've allocated your money, how much risk you've already got on the table, and what you want to achieve. Stocks are about the future. Annuities are expensive. I would argue they're about the past. Real estate is an inflation. Yeah, unless you've got really specific knowledge about what you're doing, I think the better bet always is going to be the stocks, but again, that is an individual decision, and I don't know your individual parameters and your risk tolerances, so I can't offer that individualized advice. Next question. I don't understand the economy well, but I feel like we're in a big Ponzi scheme. Do you get that feeling too? Absolutely. Excellent question, no doubt about it. Yes, it's a big Ponzi scheme, but when has government ever not been a big Ponzi scheme? Socialism, you know, or democracy, or whatever, it doesn't matter what you label it. Government is designed for one purpose. It's designed to spend your money. So if you make profits, you give a portion of that to the government, you get goods and services and medical provision, military, all kinds of other things for it. But there's never been an instance in recorded history where a government has been able to spend its money better than an individual has been able to spend his or her money. So now, what do you do with that information? Well, you can stay up all night worrying about whether this is a Ponzi scheme. You can worry about whether you're right or wrong about this is a good or a bad thing, or you can do what we do. I'm worried about being profitable. I don't care whether this is right or wrong. I mean, personally I do, but professionally my job as Chief Investment Strategist is to make sure that you make money and build a better financial future, no matter whether this is a Ponzi scheme or not. So with that vein of thought, I would encourage you, take a deep breath, grab your favorite libation, whether it's coffee or a good martini, put a smile on your face and don't worry about whether it's a Ponzi scheme. Because if you've got your risk management covered, you're focused on the unstoppable trends and the best companies and the best CEOs, like we talked about a few minutes ago, then you've got your bases covered as best as you possibly can, and you're looking to the future, not the past. Does that make sense? I hope so, and if not, send me a follow-up, because this is a topic that we're going to talk about probably for the rest of our investing lifetimes. Here's why. CEOs are driven by profit. They're driven by the future. They play with real money. That's a very different perspective from a politician who is solely concerned with spending your money and being reelected. Half of the politicians I've ever talked to can't balance their checkbook, let alone understand what a derivative is or how to pick a good stock. So who do you follow? Well, you can talk about the politicians all day long, but I would encourage you to follow the CEOs, because they're the ones who understand real money, real growth, and real profits, the stuff that you and I want to use to build our future. Next question. What is the best way to trade stocks on my own without a lot of money? Oh boy. The answer is don't. Here's the thing. If you don't have a lot of money, you don't want to be a trader. And I'll tell you why. When you're trading, And truly trading, it comes down to the meaning of this word. Trading means you are in and out frequently, you are moving quickly, you're making decisions at light speed or by minute, hour by hour. The problem with that, some people are successful at doing that, but that's a game of capitalization. So if you've got a little money, trading by its very definition is the absolute opposite of what you want to do, unless you are absolutely ruthless with risk control, willing to take a loss, and can live without the money that you're going to throw away because maybe you've got to experiment or maybe you got to learn. My suggestion would be that you paper trade without a lot of money until you get comfortable with the variables I've just mentioned, and take the real money and put it in investments. Investments, by their very definition, are things that you make your money work for. You put in, you leave alone, let your money work. You don't want to be second guessing the market, and you don't want to be competing against thousands of other traders who are moving tens of millions, hundreds of millions of dollars at a time, and who could care less about what your unique circumstances are. Their job, and I know because I used to be one of them, their job is to separate you from your money, and it is not a nice business nor a pretty picture. So you can trade or you can invest. Understand the difference between what those words mean, and then let's have another talk about how you pursue that. In the meantime, think about what that means and don't confuse one for the other. Are you staying in the markets right now? I am encouraging everybody to stay in the markets right now because you have to be in to win. If you step out of the markets, it may feel good, it may make you sleep better at night, but if you can absolutely afford to do it, I would strongly encourage you not to chicken out. Stay in the markets because that's how you make money. And bear with me for a second. I just happen to have some statistics I prepared for a debate I'm participating in later today. It's called the Bulls and the Bears. And I get this question all the time. Should I stay in or should I go out? Let me tell you what I mean by in to win. All right? Let's take some of those very same stocks we talked about. And people ask me all the time, say, should I stay in or should I go out? Well, my argument is you stay in and you manage your risk accordingly. Let me give you an example. In late 1999, people told me, I can't tell how many times, there's nothing to buy, stocks are too expensive, this is terrible, I don't want to participate. And a good number of them went to the sidelines. Well, those that didn't, at my encouragement, stayed in with a stock like, for example, Altria. Since 12/31/1999, through two 50-something% corrections, couple wars, regional conflicts, all kinds of political nonsense, hijinks, the Fed is asleep at this week. I mean, you just name it. It's happened in the last 17 years. Yet, Altria has returned 3,354.93%. That is enough to turn every $10,000 you invested on December 31st in 1999 into $345,492.96 today. But the only way you get that kind of return is if you stay in to win. And you reinvest, and you do all the things we talk about at Money Morning, and Total Wealth, and the Money Map Report. In to win, focus on the CEOs. There's a reason why I keep coming back to this. It's because that's how you build the wealth. Now, I know I sound like a broken record, but let me give you another example. Everybody says, well, gosh, I can't afford to do that. I don't have all those years. All right, well, fine. In 2009, everybody was convinced that the world was ending. I can't tell you how many emails I got, people saying, hey, this is gonna go over the cliff, I don't wanna be a part of it. And I said, no. You've got to go for those right companies, the right CEOs, the things that are growing anyway. Becton Dickinson, single-use medical supplies, global markets, total return since March 11, right off the bottom, 2009, 287.96%. That's enough to turn every $10,000 invested into $38,796.03. You can avoid the markets. You can step out of the markets. You can argue all day long about whether this is a good thing or bad thing, right or wrong. You can talk about the politics, the Fed. None of it matters. If you focus on what we do all the time, which is the unstoppable trends, the trillions of dollars are going to get spent anyway, you're lined up with the money, not against the money. If you focus on the must-have companies that are making products you have to have, the world cannot live without, including the big tech stocks, you're gonna be just fine. You're gonna go up and down, there's gonna be periods where you're gonna question your sanity, maybe even hate my guts. But the bottom line is, history shows, beyond any shadow of a doubt, being in to win is the far more profitable strategy than trying to second guess the markets and periodically jumping in and jumping out. 82% of all buy, sell, hold decisions are wrong according to the research, which means to be right, you either don't make them in the first place and you manage your risk, or you simply tap into those companies that are growing no matter what. I will do my very best to guide you to what those companies are. I will help discover the opportunities around the world as I find them, and I hope we have many, many more opportunities to sit down like we are today and talk about these things. Because if there's one thing that is very clear and why it's an unstoppable trend is that technology like this gives us the potential to do what we're doing today. I couldn't have sat down and had this discussion 5 or even 10 years ago. Technology didn't exist. To me, that's both exciting, compelling, and an investment opportunity. I'm Keith Fitz-Gerald, Chief Investment Strategist for Total Wealth and Money Morning. Thank you very much for joining me today, and I will see you again soon.